Hey, what's up everybody? Today I'm going to talk a little bit about your maximum refund and if that's what you actually want is a maximum refund or if there's another way to look at this. Now I've covered this a little bit in another video, so you can click the link there if you want to check that one out. But I'm going to cover it, like I said, a little bit differently today. My name is Brad, I'm with Wooten CPA, and I'm here to bring peace to your finance and tax responsibilities through these YouTube videos. So I hope that they are doing that. Don't forget to subscribe to the channel, hit the bell so you get notified when each video pops up. So today, what are we talking about? We're talking about this marketing gimmick. Yeah, I think it's a marketing gimmick. I know it's a marketing gimmick because they're talking about your maximum refund. Well, your tax situation is not all about your refund. And so, first of all, is a maximum refund what you actually want? Do you want the largest refund possible? And is your refund actually telling the true story of your tax situation, your tax responsibility? All right, so you're gonna notice a little bit of a wardrobe change there, and that's because typically I record my videos all in one shot, and this particular time I thought of this analogy after I had already done the recording and actually already done the editing on the video. I'm gonna post this video tomorrow morning, so this is Monday night, and I thought of this analogy and I wanted to throw it into the video, so that's why a little bit of the wardrobe change. So we're going to be talking about the refund. We're going to be talking about what number you want to pay attention to instead of the refund. And I thought about this analogy that I wanted to share with you to help you understand this. So let's say that you're going out to eat with a friend. So you and your friend are going to go to a restaurant for lunch. And what you're going to do is you're going to walk into the restaurant. You're going to actually prepay for your meal. Now, I know that doesn't happen very often, but I think the analogy will still make sense. So you're going to walk in, and you're going to hand the waiter $20, and you're going to prepay for your lunch. Your friend is going to walk in, and your friend is going to prepay $10 for their lunch. Then you're going to proceed to order the exact same lunch. And so you're going to spend $15 on your lunch. Your friend is going to spend $15 on their lunch, ordering the same exact meal, enjoying it exactly the same. And when the waiter comes back, he is going to bring you a $5 bill back, and he's going to give you change or a refund of $5. Your friend, however, is going to get a bill. The waiter's going to come back and say, hey, you gave me $10, but it was $15. You owe me $5. So your friend is going to have to pay an additional $5. Which one of you is in a better situation? Well, when we think about taxes, we think about refunds, and we talk to each other about our tax situation. This friend is going to brag to this friend and say, I got a refund, therefore I did a better job preparing my taxes. My CPA is better than yours because he got me a refund. But you both had the exact same meal, so you can clearly see that the refund is not the number you want to be paying attention to. The only reason why he got a refund, why he had to pay and you got a refund, is because you prepaid different amounts. You ordered the exact same meal. So let's take that and say, okay, well, what happens in this particular situation when you and a friend both go to the restaurant and you prepay $20 and he prepays $10 and you order different meals? So let's say you order a meal that costs $17 and he orders a meal that costs $12. You are still going to get a refund or change back of $3. Your friend is going to owe $2. And so once again, you're going to say, I have a better CPA than you. I got a refund. You had to pay taxes. You need to go to a different CPA who's going to be able to help your tax situation out. You need to go to someone who's going to help you get more of a refund for your lunch. All right? So, but your friend's smart, and he's going to say, actually, you spent $17 on lunch. You may have gotten a $3 change back after you ate lunch, but you spent $17 on lunch, and I only spent $12. So who is better off financially? Well, your friend is, because they spent less money on the meal itself. The amount refunded or the change they got back is completely reliant upon the amount of money that you prepaid. So we're going to see how this actually plays into the numbers on your tax return, what you want to pay attention to instead of the refund, because again, the refund doesn't matter at all. It's all about what you actually pay for the meal, or in this case, what you actually pay in taxes to the government. So let's jump back to my original video. We'll walk through basically the same concept as it relates to your tax return and see what numbers you want to be paying attention to. Maximum refund, that's not actually the goal. What's the goal of your tax return? The goal is you want it to be accurate. I mean, I can get you a giant refund by plugging in a bunch of fake numbers. You know, we put in your W-2 and then we just make up some deductions and you can get a large refund. And so you'll get your maximum refund by one definition, except it's not legally allowed. You would go to jail if you got caught for doing a false return. Now, TurboTax isn't, marketing. They're going to do that for you. Neither of the other self-prep softwares. So what's the next question? The next question is, can they get you more of a refund than another one? So question, does the preparer or the software get you a larger refund? Now, the answer to this question is no, absolutely not. The tax computation is a basic algebra formula. It's adding, it's subtracting, and it's multiplying. And if you put the same data into one program as you do another one, you're going to get the exact same tax situation. Now, I have some other videos. You can check out the TurboTax video. Try to put a link up there to that one, as well as the 1040.com video, where I actually walk through preparing the same tax return in each of those softwares in those two different videos, and then give a review of which software I like, or if you should use that software, to give you an idea of if it's something that would be good for you. And then also compare the cost of those as well. And what happened was I did TurboTax, I did 1040.com, and then I did my professional software that I use, which is Drake. 1040.com is made by Drake, but the tax refund, the federal refund, I put the same information in, same scenario into both, and the tax refund was the same in 1040.com as it was in Drake. Makes sense, same company makes them, even though they're different softwares. The refund for the federal was the exact same, as well as the state tax situation. And then on TurboTax, the refund was $12 more. So for all intents and purposes, it was the same exact refund. Again, because I put in the same information, it's going to be the same result. Now, why it was $12 different? I actually deleted my TurboTax account before I kind of went back and dug in and looked at the return. But when I did the 1040.com and the Drake tax software program that I used, I went back, I looked at the return, saw the taxable income, I went to the instructions for the 1040, I looked at the tax table myself for that income, and the tax table gave me the exact income that was in 1040.com as well as Drake. So I'm not 100% sure where the extra $12 came from on the TurboTax return, but in my opinion, as long as I keyed everything in exactly the same, then that extra $12 isn't actually correct, because the tax table is what you're supposed to use. Now, there is other ways to do your tax computation. There's a worksheet to use, but in this particular situation with the return that I put in, I don't think that you would actually use that computation worksheet. You would use the tables, which is what the 1040.com and Drake tax software gave me, the exact tax from those. Now, so there you have it. It's 3 different softwares. TurboTax saying we'll get you your maximum refund. 1040.com has that in there, but it's not as gimmicky. They're not really a mass marketed self-prep software. It's more, I actually have a link that I'll put down at the bottom, where if you use that link, I get a referral. Now, the cost for 1040.com is only $25 total. So my referral fee might be, $12, $15 or something. So it's nothing. And it's not why I would recommend that software. If you're going to self-prep, TurboTax, 1040.com, they're the same, except 1040.com is cheaper and a little bit more scaled back, a little easier, I think, to navigate if you know what you're doing and you're jumping around. So Let's get to why this maximum refund is a horrible idea. Well, first of all, if you're getting a refund, well, what is that refund? Now, I'll tell you again, the tax computation, it's basic math, right? So you've got income, and you add up all of your taxable income, and then you have some deductions that you can subtract from that income in order to get your AGI or your adjusted gross income. Then there's a few other deductions, such as the standard deduction or itemized deductions that you can subtract from your AGI. And I'm going to skip a couple of things here. There's some tax credits, there's some additional taxes, but basically, the general principle is income minus deductions, adjusted gross income. Take a little bit more deductions off from that if you can, and then you're going to get your taxable income. So maybe this is 54,000. This deductions are 4,000. I don't know. There's not very many that are that high in that particular part of the tax return, but let's say it's 4,000. Your AGI is 50. Let's say the standard deduction is 20,000. For married couple filing jointly, it's actually 24,400 this year. But for math simplicity, we're going to say 20,000. That's going to give you taxable income of $30,000. Now, what you do at this point is you basically go, like I said, to the tax table, and it says if you're married filing jointly and your taxable income is $30,000, this is what your tax is. So basically, that's a simple way to figure out your tax without having to go through and multiply it out yourself. Where the first $10,000 is taxed at 10%, the next $50,000 is taxed at 12%. It's basically just a simple way, so you don't have to do the math, and it'll say, okay, your tax on this is $3,000. So we'll assume 10% here on all of it, of that taxable income. So that's the basic computation for what your tax liability is. So that's your tax liability. This number is very important. We'll come back to that number. Now, the next thing you have is you have some tax credits. Now, some of these credits, I'm sorry, that's completely impossible to read, but what you have are tax credits. Now, credits are kind of like deductions, except deductions you took off of your taxable income before you calculated your tax. Tax credits are calculated, and then they give you an amount of money that you can subtract directly from the tax. So let's say you have some tax credits of $500. Those are going to reduce your tax dollar for dollar down to $2,500 of tax liability. So some of those might be the child tax credit, or retirement savers credit, or education credit. So there's some credits there that you can take off. That's going to give you your total tax. And then there are some more credits that are actually refundable, where if they're more than this, you can get those refunded to you. Those are fantastic credits, because even if they wipe your tax liability out to zero, or your tax liability starts out at zero, you can get those refunded to you, such as part of the child tax credit and part of the earned income tax credit, and part of the child tax credit can be refunded to you, whether you owe any tax liability or not. So now you have your total tax, and then what you put in are estimated tax payments. If you're self-employed, you might be making quarterly estimated tax payments, or for the majority of you, if you're a W-2 employee, you're going to have W-2 withholding. So this is income tax that has been withheld from your paycheck. So let's say that's $5,000 of withholding. Then because 2,500 minus 5,000, 5,000 is more than what your total tax is, you will get a refund of $2,500. Now, had your withholding only been $2,000 and your tax was $2,500, you would obviously owe $500. So this is the basic computation. So when they say you get your maximum refund, we're all focusing on this number right here of what you're going to get back from the federal government. The problem is, what exactly are you getting back? You're getting back your own money that was withheld from your paycheck. So basically, you gave the government $2,500 more than you needed to. They sat on it for an entire year, and then they're going to give it back to you now, February, March, April of the following year. So you basically loaned the government $2,500, and they paid you zero interest. So even if you put this in some kind of savings account, get 1% interest, it's better than loaning it to the government where you get zero, or it's in your pocket and you can use it in your monthly budget. If you divide that out by 10 paychecks, I mean, if you divide that out by say 24 paychecks because you get paid twice a month, you get a little bit more every month in your pocket that you can use for your spending, or you can save yourself in some kind of interest-bearing account, and it's better than loaning it to the government. So, do you want a large refund? I would say, from a pure financial standpoint, you do not want a large refund. You don't want a refund at all. You want to either break even, or if you actually end up owing the government, say we only withheld 2,000, and you end up owing the government $500, as long as you've paid in enough that they're not going to charge you interest and penalties for under withholding, or you somehow get it to where you break even and you owe them nothing. But if you owe 500 at the end of the tax return, then you've actually borrowed $500 from the government and paid zero interest on it. Again, now there's interest and penalties for under withholding, if depending on a couple of calculations, but there are ways and situations where you could owe a little bit to the government and not owe any interest and penalties. So you've borrowed money from them interest free, and now you're paying. Or you basically get this really close to zero where you're getting a couple $100 refund, or you're paying a couple $100. And I would say, from a pure financial standpoint, that's exactly where you want to be. Now, I get it. People like the large refund. It's kind of a forced savings where you're putting in a little bit extra out of your paycheck. You're not really thinking about it because it's what the withholding is, and then you get this nice refund, and you can go spend it on vacation, or give it to a charity that you wanted to, or have a fun kind of shopping spree with your family or whatever. It's forced savings, and people like that, and I get it. You like the feeling of that. But again, all that marketing gimmick is focused on this refund number of, let's get that number as high as possible. Well, again, assuming that your tax situation is what it is, there's a right and a wrong tax return for you. Again, there are some more creative things when you have maybe a business, or more opportunities or things you might miss out on when you have a more complex situation. But for the large majority of us, we have W-2 income or self-employment income, and there is a correct return, and anything else is incorrect, because you can't take deductions for things that didn't actually happen, and you can't not report some income. So basically, you have to report what happened, and then the math problem is what it is, and that's your tax situation. So with that said, you're not really trying to increase your refund. What you want to do is you want to decrease this number right here. So the number that you need to focus on, and I forget exactly what line number it is. It's around line 12, or anyway, the tax liability, but then you got the total tax down here. So you want to look for that. This is what your total tax is, or this is your total income tax, right after your taxable income. That's the number you want to drive down. You want to get that number down. Who cares what your refund is? Because your refund is based on how much money you put in compared to your tax liability. So what you actually want to do is pay the lowest possible tax. You want the lowest possible tax liability that you can get. Now, the IRS even agrees with this. There's nothing illegal unless you just make stuff up or you do things against what the law says. But if you take legitimate deductions and you do legitimate things that can be deducted from your taxable income, then the government says, your responsibility is to pay the least amount of tax that you legally owe. So it's completely fine to do legal things to reduce your tax liability. Some of those things would be contributing to an IRA. So if you contribute to an IRA, then a traditional IRA, you can deduct you can deduct what you contribute to that traditional IRA. If you're in a 401k or retirement plan with your company and you defer more money into that up to the limit that you're allowed to, that's just going to reduce your taxable income here. So driving those numbers down will drive down your tax liability. And so that's what you want to do. You want to drive down your tax liability, because this number could be 33,000, but if your withholding was 50, you're going to get a nice refund, but the refund really doesn't matter. What you care about is paying less income tax legally. And so again, there's strategies you can do in a business that are legal, certain different ways of depreciating assets, different strategic things you can do to drive that number down. And so that's honestly that's the key. So I hope that I've debunked this whole let's focus on the refund and get our maximum refund and shown you that the important number is your actual tax liability. How can you drive that number down legally? And then, using your withholding or estimated tax payments as kind of a forced savings to get a refund if that's something you're comfortable with, but how now you can brag about my tax refund was nothing. I didn't loan the government any money. You're a sucker for loaning the government $5,000 and getting this giant $5,000 refund. Um, and you can actually brag about the fact that you didn't get a large refund because you know the reality of what's going on. So don't fall for that marketing gimmick hype. That's not what's important. It's not the refund amount. Now, again, I mentioned some of these tax credits, like the earned income tax credit and the a portion of the child tax credit is refundable. So let me cover that real quick because that is a situation where you still kind of want to end up with a refund. So let's say you projected out your taxes perfectly and your tax liability was 3,000 and your withholding was 3,000, so that was zero, but maybe you're eligible for the additional child tax credit. And so even though that kind of washes out, you could get 1,400 per kid refunded to you from the child tax credit, and so it's possible you're getting a refund of money that was not part of your withholding. And so again, you either qualify for it or you don't. So it's not exactly a strategy. Now you could strategize by having another kid and getting that, but I can tell you they're going to cost you more than $1,400. So it's not exactly a great net cash strategy. That's another one, real quick. People say, well, how can I get a larger refund or reduce my tax liability because I don't want to pay that much in tax? Well, the thing is, with deductions, you shell out $5,000. You're only going to save 500 in taxes if you're in a 10% tax bracket, $1,000 in taxes if you're in a 20% tax bracket. And so you're always going to have to put out more money than what you save in taxes because you're just getting a deduction times the percentage of whatever tax bracket you're in. So you can never spend 500 or and get a reduce your tax by that exact amount or reduce your tax by more than what you spend out. So on a net cash basis, you're always going to be out more cash trying to get some extra deductions. But again, you got to save for retirement anyway, so might as well put $5,000 into that. And if you're in the 20% tax bracket, pay $1,000 less in tax. You get to keep that money. And again, your cash out of pocket's 4,000. 5,000 minus the 1,000 you save in taxes, your cash out of pocket. But you didn't pay 1,000 to the government. You gave 5,000 to yourself, saved 1,000 from giving to the government. So real quick there on that. But again, debunk this myth. Maximum refunds, not the gimmick, not the marketing you want to fall for. So hopefully this has been very helpful to you. Check out some of my other videos, share them, and I hope to continue bringing peace to you and your finance and tax responsibilities. Comment below, ask questions if you want me to go into more detail on anything, or if you want me to cover some other topic. I appreciate you watching the video. Thanks a lot.